Let's turn back to the market sell-off, getting milder by the moment here off of that hotter-than-expected CPI. Let's bring in Allspring Global Investments Head of Active Equity, Ann Maletti, and Barclays Head of Global Inflation-Linked Research, Mike Pond. Thank you guys for being with us. And I just wonder, very short term, the bounce this morning, the VIX lower. Is it your sense that the CPI internals are getting a second look? What happened this morning, do you think?
Well, I do think that, although the trend was disappointing, not seeing quick enough deceleration in inflation, it doesn't change too much of the outlook. Certainly doesn't change what we thought would happen in November. As Steve Leisman pointed out, we are likely to see a bigger impact in the December action from the Fed. So that might be disappointing. But I think investors, certainly our investment teams, have much anticipated that the Fed's going to do some really hard work and focus on what they need to do to fight inflation, even at the expense of the economy. So multiple compression has been really big, about 30%. We are starting to see that earnings estimates, come down, I think 15 of the last 16 weeks, and we're seeing it again this morning. So a lot of the work is already being priced into the market. And so seeing a small bounce after the negative print isn't that shocking.
Right. Mike, it sounds like you think the market is pricing in maybe too much inflation next year, but not enough over the longer term.
That's right. The market's still priced for around 3% inflation as we look into next year, so on a forward-looking basis. But then out the curve, it's only pricing in levels that are barely consistent with the Fed's forecast from the downside. So we think that the disinflation risk from an overshoot from the Fed, from the move in the dollar, from lower transportation costs, lower commodity prices, it runs the risk of too low inflation next year. But the structural factors in the market, such as deglobalization, energy transition costs, actually raise structural inflation pressures, which we don't think the market is pricing in from an inflation risk premium standpoint.
Let me follow up on that, given you are the head of Global Inflation-Linked Research. Michael, what about the services component here? Up 0.8% seems to be giving a number of people real pause. I'm just curious to get your reaction to it and whether, in fact, it does, given services inflation can prove stickier over time, mean the Fed perhaps goes higher longer.
Right. So clearly we're seeing that long discussed shift from consumer buying of goods to services. Goods price inflation was 0 in today's print, but services was much stronger at 0.8. A lot of that was shelter. And shelter, as we all know, is a lagging indicator of what's going on in the rental market by about 9 months. But that doesn't matter because the Fed is focused on realized inflation data, not forward-looking as it used to be, because they were humbled by their inflation forecasts over the past year.
Shepard Smith here. Thanks for watching CNBC on YouTube.